Thank you for joining us. This is Managing 2020 Tax and Retirement Strategies During Uncertain Economic Times. Today, John Goodnough, Sacred Heart Class of 2019, and shoe parent Joseph Lombardi, founder of Lombardi Associates, will share strategies related to the 2020 tax changes and the recently passed Secure Act and CARES Act. They will discuss the impact these changes may have on your current financial lifestyle and retirement goals during these uncertain economic times. Welcome, John and Joe.
Hi, everyone. Welcome to our 2020 presentation on retirement savings and tax strategies. Before Joe and I get started, we just want to say that we hope you and your families are staying well during these unprecedented times. I'm John Goodnough, and I graduated from Sacred Heart in 2019 with a bachelor's degree in finance and marketing. I decided to join Ameriprise due to the client service experience, the team atmosphere, and the ability to impact lives. I will be discussing today the different kinds of 2020 tax changes and strategies. Next slide. So there are three different ways investments are taxed. There's tax-free, taxable, and tax-deferred. Most Americans for their retirement planning have a lot of their assets in the tax-deferred bucket. This is followed by the taxable bucket and the least amount in the tax-free bucket. A possible issue with this is that the current tax rates are low versus historical averages and likely to increase in the future, thus having a greater impact on tax-deferred and taxable buckets. The current tax laws are scheduled to expire in 2025. Everyone's financial situation is different, which is why proper tax diversification planning and retirement planning is important on an individual basis. So next slide. So now we're going to dive into the specific accounts and investments associated with each tax bucket. Starting with the right side, the taxable bucket consists of any security such as bank accounts, stocks, bonds, and mutual funds. This bucket is liquid, meaning that you can quickly take these investments and turn them into cash. Income generated from these vehicles is taxed each year depending upon individual federal and state brackets. Gains on these vehicles are taxed upon the sale at ordinary income tax rates or capital gains rates depending upon the type of investment and time frame they are held. Now we're going to go to the middle, what's on your slide, in the tax deferred bucket. So the tax deferred bucket consists of investments like traditional IRAs, 401ks, 403bs, and more. You're able to deduct your contributions for the current year from your taxable income, but you will be taxed at ordinary income tax rates upon withdrawal, and you can't touch it until 59.5 without penalty except in hardship cases. So now on the left side of your screen, we're going to be talking about the tax-free bucket. So the tax-free bucket consists of investments like Roth IRAs, cash value of life insurance, and municipal bonds. Focusing on Roth IRAs, these investments are illiquid, meaning you cannot touch the money until after 59.5 years old without penalty. These investments grow tax-deferred but come out tax-free. There are limitations on the amount and eligibility to contribute to a Roth IRA based on your income. So therefore, we believe it is important to have money in each of these tax buckets. There are a lot more details I didn't touch upon today when discussing the tax buckets, which is why proper tax diversification planning and retirement planning is so important. So as a hypothetical example, due to compounding, it is very important to start as young as possible. So for example, you have person A who invested $5,000 a year from age 25 to 35, and person B who invested from age 35 to 60. Person A contributed a total of $55,000 and person B a total of $130,000. Assuming an 8% annual return, person A, who started earlier, contributed for less years and less money, would have around a $616,000 by age 60, compared to person B, who would have $432,000 by age 60. So what this really shows is that the number one thing for saving is long term, even if the amount is small. So what we found is that everyone's financial situation is different, and therefore investment and tax strategies need to be developed on an individual basis. Now we're going to go to Joe, who will talk more about other recent tax and retirement changes. Thank you.
Thanks, John. Good afternoon, everybody. Name is Joe Lombardi. I have two children, recent graduates from Sacred Heart University. My daughter Miranda graduated with a BS in psychology in May in 2019. She's in the middle there of the picture. She also graduated with her master's in elementary education from Sacred Heart in May of 2018. Paul, my son on the left, graduated with John, class of 2019, with a BS in sports communication. And the redhead on the right, my son Nick, is a rising junior at Sacred Heart. He's in the Welch Business School, finance major. So we love the school. A lot of great memories. The kids have gotten a great education. My wife Terry and I, in this picture at one of the SHU football games last fall, have been members of the parent council at SHU for the last 5 years. Me personally, I graduated from St. Michael's College with a BS in biology, actually. Got my MBA in finance from LIU. I started the business in 1992, so I'm an old guy. I've been doing this a long time. Certified financial planner, and love what we do, helping clients work towards their financial goals. So I'm going to hit on a couple of key topics and key things that happened recently, and key laws that were passed. The first one was the Secure Act. So the Secure Act, setting every community up for retirement enhancement, was passed into law on December 20th of 2019. Most of the provisions actually went into effect as of January 1st of this year. So one of the key things that the Secure Act did was it increased the age for required minimum distributions from the April 1st of the year after you turn 70 and a half to the April 1st of the year after you turn 72. So this pushed the age out. For retirees, that could be a very good thing because you have a longer period of time that you can let your money grow. But there are other implications that came as part of this as well. Next slide. So the timing when you take the distribution from any type of retirement account, whether it's a 401k plan, a 403b plan, an IRA, etc., all depends on each person's individual situation. Maybe putting off the distributions till you have to start at age 72 makes sense, but that's not always the case. Sometimes taking the money or a portion of the money to help with expenses that you have during retirement and starting to spread the money out, especially if you have sizable retirement assets, may make sense earlier. Some people consider doing Roth conversions. That's where you pay the taxes up front on a portion of the retirement money, and then it goes into a Roth IRA. And as John talked about before, the benefits of the Roth is it then grows tax-free. But the key to all of this is every individual situation is completely different. What is right for one person may not be right for somebody else. So a strategy needs to be put in place onto how to properly withdraw money during the retirement years and from which of the three buckets to take it from, whether it's from the tax-free bucket, the taxable bucket, or the tax-deferred bucket. Next slide. One of the key features that came into law a handful of years back is retirees have an option to not take their required minimum distribution. Instead of taking it or not taking the full amount, you can directly gift a portion of the required minimum distribution to a qualified charity. And if you do that, that amount is not taxable to you. The amount that's the maximum amount you can gift in any 1 year to a charity from your retirement assets, and again, those are 401k assets, 403b assets, or IRA assets, is $100,000. Now, the old required minimum distributions used to start at 70.5. The government, through the Secure Act, pushed that to age 72. But the age at which you can start making the distributions tax-free to charities did remain at age 70.5. So that's a little tweak to the changes that occurred in the Secure Act. Another significant change that came from the Secure Act was how it impacts distributions for beneficiaries. So this is why, because of these changes, it's important to evaluate on an individual basis and maybe even on an annual basis when would be the best time to start taking the distributions. Next slide. So in the past, you were allowed to, whenever money was passed to a spouse, it continues as if it's the spouse's money. But a non-spouse, when they inherited money that was in retirement accounts in the past, were able to defer the payments over their life expectancy. So what does that mean? They called it the stretch provision. So you inherit money from a parent, money went into an inherited IRA, and each year you had to take a very small distribution based on your life expectancy. So that was a big advantage when inheriting retirement plans. You didn't have to pay all the taxes up front. Because remember, this is pre-tax money, so as it comes out, whether it's for the retiree or for the beneficiaries, taxes need to be paid on it. One of the changes that occurred from the Secure Act is now the money, when it goes to an inherited IRA, must be distributed within 10 years, so not life expectancy. Now, that's for most people. Spouse beneficiaries, non-spouse beneficiaries who are no more than 10 years younger than the IRA owner, and beneficiaries who are disabled or chronically ill can still use that stretch provision. So there are a couple of circumstances where the stretch still comes into play, but the average person can't. Now, for a minor child who inherits an IRA, the clock doesn't start ticking on the 10-year period until that minor child reaches the age of majority. And that's different in every state. It could be as young as age 18, and it could be as old as age 21. So the effects of the changes that went into place from the Secure Act not only impact retirement savings, but also impact estate planning, because a strategy needs to come into place on the estate of those who are passing on the assets to make sure that the taxes are minimized over a period of time. So again, Secure Act, good thing for retirees, maybe not a great thing, or in some cases may not be a very good thing for the beneficiaries who inherit the money. Next slide. So that's it on the Secure Act. What I want to go into is changes that occurred because of COVID. And there were three major pieces of legislation that went into effect back in March. The one I want to focus in on is the one that went into effect on March 27th, where the government put $2 trillion in what is called the Corona Aid Relief and Economic Security Act, otherwise known as the CARES Act. So the Coronavirus Aid and Relief and Economic CARES Act provided direct payments to individuals and families who qualified based on income limits. So if in 2019 your income was less than $75,000, the government sent you a check for $1,200 to help get through the shutdown. For a family, husband and wife, if your joint income was under $150,000, each of you got $1,200, or a total of $2,400 towards the household. The other big thing that occurred from that is it also increased the amount of unemployment benefits that came out. So the federal government added an additional $600, up to $600 per week to the normal disability unemployment benefits you would be receiving for up to 4 months. And again, this was passed as a way to help families get through the difficult times of the economy being shut down, a lot of people being furloughed or laid off from work, and incomes disappearing on the short term. Next slide. So another feature of the CARES Act that came into play impacts retirement planning assets. And that's what I want to spend a little time focusing in on today. So one of the things that happened was people who work and have retirement plans, 401k plans, 403b plans, and 457a plans, have always had the ability to take a loan against those plans. In the past, the maximum amount of the loans was $50,000. As part of the CARES Act, that was increased to $100,000, or 100% of the vested balance, whichever is lower. So if you have $80,000 in your 401k plan, the maximum you could take out as a loan was $80,000. Repayment on this money was delayed throughout 2020, so you don't have to start paying it back right away. And if you already had a loan outstanding, you were exempt from paying it for the remainder of 2020 and started having to pay it again in 2021. So that was a big advantage. Another piece that came out through the act was for people who were financially strapped because of the corona shutdown, you're able to take up to $100,000 withdrawal from your retirement plans. And you're able to do that even if you're not 59 and a half without the 10% penalty. So the government allowed you to take money out of the 401k plan, 403b plan, use that money up front. There is no 10% penalty for early withdrawal. And you're allowed to take the taxes on that because that is still taxable distribution. But instead of having to declare the $100,000 as taxable income in 2020, you are able to spread the taxes over 3 tax years. So basically a third of it in 2020, a third of it in 2021, and a third of it in 2022. Also, as part of the CARES Act, if you decide and have the money and you want to put the money back in, so if you took a $50,000 distribution, but you go back to work and are able to put that back in, you have up to 3 years to put the money back into the plan and get it to continue to grow on a tax-deferred basis for yourself. So again, a lot of features. The CARES Act was passed specifically to help individuals get through these very difficult times with the shutdown. And as you can see, a bunch of the benefits, not only money up front, but really impacted retirement savings. Lastly, the CARES Act also waived the need for required minimum distributions in 2020. What does that mean? So once you get to the age of before December 31st of 2019, age 70 and a half, or now going forward, once you turn the age of 72, each year you're required to take a minimum amount out of your retirement plans. And in taking it out, you have to pay the taxes on it. So the government said all these years you've been able to put money in tax deferred. John talked about how the money compounds the sooner you get it in there and grows in retirement plans. But then eventually the government wants their taxes on it. So once you get to the age of 72 now, after 2020, you're forced to start taking money out each year and called the required minimum distribution. To help retirees, and especially those that don't need the money with the shutdown, the government waived the requirements to take a required minimum distribution in 2020. That also impacts inherited IRAs. So if you have an inherited IRA that you receive from a parent or somebody, normally you would have to take a distribution from that. That is also waived for 2020. So that's a key feature which helps individuals to recoup, not have to take money out of their portfolio when the portfolio is potentially down, and also skip the year of having to pay taxes to the federal government. So those were the key points that I wanted to hit upon in today's presentation. I think there are some questions coming through, and John and I will be here to answer the questions. So at this point in time, Jason, if you want to
absolutely, thank you guys. Thank you both very much. That was a lot of great information. Oh, I see. We're sending John up to answer the questions today. Fantastic. Well, the first one you actually answered, which was, what are the tax benefits of the CARES Act? These questions are coming in from alumni in advance, and we welcome anyone who's watching us today to post your questions in the comments section as well. But the first question I have here is, for Roth IRAs and cash value life insurance policies, you said that you can take tax withdrawals. From your experience, is this something that you would recommend based on the fees that might apply?
So again, it depends on an individual by individual basis, but just staying on Roth IRAs, there's normally an IRS fee of opening an account that's $75 for a Roth IRA. We have the possibility of waiving that fee, and then it just really depends on the investment that we put in, which is typically an aggressive mutual fund due to the time horizon that so say, for example, myself, 23 years old, until 59 and a half, that is 36 years. So that, because that's such a long time horizon, we normally put it into an aggressive mutual fund. And again, the $75 fee can be possibly waived. Now, you also mentioned cash value of life insurance. So that's not really a fee. It's mostly based upon a couple different things, because it's still life insurance, even though it has cash value in it that, again, is tax-free. Has to do with your age, has to do with your health. It has to do with many different factors that can impact a premium. So there really isn't a fee specifically for that, and more depends on your specific situation and your specific health, age, and other factors too.
Awesome, John. Thank you so much for that. In your opinion, gentlemen, do you think that the coronavirus has had a positive or a negative impact on retirement and your tax strategies that you're recommending?
Interesting question, Jason. That's a really interesting one. And the reason why I say that is from a point of view of investing, it's had a negative one. Obviously, the markets are down. Now, they've come back a long way from the bottom, but they're still down. The changes, though, that came from the CARES Act in allowing seniors to skip this year, continue to have that money instead of paying the taxes, have that grow for them and compound instead of having that go to the federal government as a help. But I don't really think that the coronavirus, you could say, had a positive impact. But the CARES Act definitely reduced the negative aspects of it, but I really don't know how you could say it was a positive.
And I have one more here. If we wanted to contact you for guidance or have future questions about our financial situation, what is the best way to do so? And I think
you have the information up on the screen. Both mine and John's email addresses are up there. Our telephone numbers are there. You can reach out to us. Give us a call, send us an email. We're more than happy to answer any questions we can have for anyone in the SHU community about these changes or anything that has to do with retirement planning strategies or any type of financial planning strategies, because that's what we do. But the information's up there. John.Goodnough at ampf.com, and myself, Joseph Lombardi at ampf.com. The telephone numbers are up on the screen. And we're here. We're here to help any way we can help, give us advice any way that we can. And the key thing in all of this is, and the key point we want to get across, despite the crazy markets, despite what has been going on, it is important to save, it is important to diversify, and it is important to not panic because the markets are down. You can actually make a strong case that now is a great time to be investing because investments are on sale, stocks are on sale. And long term, the way you make money is by investing, diversifying, and staying invested and riding through the peaks and valleys of the markets.
Well, thank you for that. That's fantastic. This is all great advice, and I want to thank you both for coming up here. Can we get John back on screen with you?
Sure.
Awesome, gentlemen. Well, on behalf of all of us here at SHU, our alumni office, special events, and everyone who's been so lucky to tune in and get this great information, we want to thank you both for this. We're going to repost later for people who have more questions or want to get further details. But on behalf of all of us from SHU, we can't wait to see you back on campus soon, and keep engaging. Thanks so much, guys.
Thank you. Have a great day. Stay safe,
Jess.
everybody.